This roadshow is brought to you by ResearchBytes.com.
Hello, good evening everyone. On behalf of JSW Steel, I welcome all of you who have gathered here to discuss the fourth quarter and full year fiscal 2016 results. We have with us the senior management team of JSW Steel, represented by Mr. Seshagiri Rao, the Joint Managing Director and Group CFO. Mr. Jayant Acharya, Director Commercial and Marketing, and Dr. Vinod Novel, the Deputy Managing Director. We will start with a few minutes of opening remarks by Mr. Rao, and then we'll open it up for Q&A and make it more efficient for everyone. We also have the opportunity for all the audience who are listening into the live webcast to ask questions, and they can also ask questions, so we'll be doing that as well. And once we have opened up for Q&A, would request you to limit your questions to 2 per analyst in order to give everybody a fair chance. So with that, we'll open it up and over to Mr. Rao. Thank you.
Good evening to everybody. I welcome you all for the briefing of our performance for the Q4 FY 2016. As you are aware, as far as last year is concerned, there was a contraction in demand. Globally, steel industry was under serious stress and threat. Global demand has fallen. If I look at the top 10 steel consuming countries in the world, out of 10, which constitute 75% of the total steel demand, 6 countries there was a negative demand. So it decelerated to a large extent. Out of that, the 3 countries, if we can pick up, China is 5.4%. You must be knowing the numbers. If I look at Russia and Brazil, it is almost close to 8% and 16%. That is the kind of drop in the steel demand which has happened. This all translated to a lower demand of 3%. So there is a surplus steel looking for the markets. So India's steel imports continue to surge. So it went up by 26% in the last financial year. After the MIP was announced by the Government of India on 5th of February, we have seen some moderation, not to an extent which we all desire in the last financial year. At the same time, because of certain stimulus which has been announced in China, internationally the prices looked up. Prices went up as high as $100 per ton, which we have seen a low of $270. It went up to 370 plus by March itself. So the international prices went up close to 37-40%. Domestic prices also looked up in the last quarter. It went up around 15% in the local market, including JSW. So that is how the total quarter spanned out in the last quarter. But one good thing which I wanted to share with you is all the 3 furnaces which we have taken this shutdown, even though they got delayed, we commissioned all the 3 successfully. 5th of February 2016 we commissioned at Salem, and 10th of February we commissioned at Vijayanagar, and the first half of March we have commissioned in Dolvi. And the last quarter results did not really include the full benefit of this 4 million ton extra capacity that is available to JSW. Vijayanagar and Salem is fully stabilized. Dolvi is working at a capacity utilization of around 70-75% right now. So there is further scope going forward as regards to volumes. We already put the presentation on the website. You all must be knowing the numbers. Just to refresh your mind, in the last quarter we have produced 3.21 million ton of crude steel, which is a 5% growth compared to corresponding quarter of last year. Sequentially, we have picked up quite a lot. Sales highest ever, 3.28 million ton, again a growth of 7%. We also reduced our inventories, which is very important. If I look at 31st March 2015, our inventory was 9,66,000. We brought it down to 8,29,000 as on 31st March 2016. So it is significantly down compared to December. But even if you compare with March, inventories were down as on 31st March 15. That is why we have seen highest ever sales for the quarter last time. Blended NSR is gone up by only 2% sequentially. Even though compared to corresponding quarter of last year, it went down by 17%. Sequentially, the benefit which I was talking about, 15% increase in prices, is translated on the blended basis only 2%. So the full benefit has not come in the last quarter, the increased prices. Iron ore prices went up in the last quarter, 150 rupees in the month of February by NMDC. So we have taken into account, already accounted that increase in prices. But coal, there was a reduction in the price. So it offset most of the increases that has happened. So overall, there was a reduction in the cost of production in the last quarter. All this together, the EBITDA per ton is 5,400 rupees in the Q4, which is quite an improvement over Q3, which was 3,400 rupees per ton. Interest and depreciation is more or less on the same level. So we have posted a net profit of 372 crores on standalone basis. On a consolidated basis, just to give a brief on the subsidiaries, Amba River has done well in the last quarter. Similarly, Coated, Salav we have restarted. It is ramping up production. Once the blast furnace achieves 100% capacity in Dolvi, we will be able to use a significant portion of the Salav DRI. So we will increase the production further in Salav. So Salav has not contributed in the last quarter as far as Indian subsidiaries are concerned. All other subsidiaries in India have done well. Overseas subsidiaries continues to be a drag as we have done in the Q3. The Chile iron ore mine and the coking coal mine, they are all under maintenance. Plate and pipe mill, the demand is not good. That is why realization is still, the capacity utilization is still lower. So it continues to be a drag as far as overseas subsidiaries are concerned. Taking all this into account, my net profit, the EBITDA consolidated basis is 1825 crores and the PAT is 171 crores on a consolidated basis. As regards to guidance which we have given, we are at 94% of our guidance. We said total we will be lower last time when we met. So we have achieved 12.56 million ton total production crude steel. Similarly, sales side we have achieved 12.13 million ton. In this, what is very important to note is that our domestic sales have gone up volume wise by 21%. So that is one big achievement we have done. When the growth in demand is only 4.5%, there is a significant market share which we could take year as a whole, and also in the quarter it was 24% more. As regards to the overall debt, net debt is 38,461 crores. This is after commissioning 4 million ton. So this is the debt of the company. So I am also happy to say that the board has recommended a dividend of 7 rupees 50 paise to the shareholders for approval. Our AGM is scheduled in the July. Total capital expenditure going forward. Last year we have given a guidance of 9,000 crores. Out of 9,000 crores, we have incurred around 4,900 crores of rupees. Balance left is 4,100 crores. We have reviewed very carefully the expenditure which is being carried forward. So savings and the other projects which we have thought not required to be implemented, that is approximately 1,100 crores. So the balance carry forward capex is 3,000 crores from the last year, which is yet to be spent on the ongoing projects. Then we looked at what is required to be done for the current financial year, either towards backward integration or any projects which can reduce the cost where the payback period is less than 18 months time. So those projects got identified. So, and also for normal maintenance capex is around 1,280 crores of rupees for 2 years. That also has been taken into account. So all this together, 4,000 crores is the new projects which we identified, including 1,280 crores of normal maintenance capex. So this 4,000 plus 3,000 is 7,000 crores. This will be spent over a period of 2 years. 4,200 crores in the FY17. Balance will be FY18. Here there are 2 or 3 projects which I would like to bring to your attention. One project is pipe conveyor at Vijayanagar. So we bring almost 20-22 million tons of iron ore by road or rail. We spend close to 400 to 500 rupees per ton to bring it either road is very expensive, it is 500 rupees. If it is rail, it is 293 rupees per ton. So weighted average basis, we spend a lot of money in the transportation. Whereas we would like to set up a pipe conveyor costing around 650 crores of rupees. The cost can come down to 50 rupees per ton per transportation. This 650 crore pipe conveyor project will take 24 months, including the approvals that are required to be taken by the company. So this is one of the important projects. Cost will be reduced substantially, where the payback period is less than 18 months. Second project which we have provided for is water reservoir. We had faced a serious problem at Vijayanagar because of water shortage, because monsoon got delayed for 2 years. We have only 21 days water storage. That is not enough. If the same situation recurs in future, so we have to provide insurance. I don't say it is a cost reduction, but essential infrastructure which we need to look at. So we are setting up another water reservoir. We'll have 90 days capacity. So that we are spending approximately 520 crores for that project. This is the second project. The third is now 18 million ton when total capacity is in operation. Compared to our total coke requirement, we are finding short of coke to the extent of 1.7 million ton. So this we have to buy in the market. As you know, coke prices are very volatile. So in the medium term, we have to look at having completely 100% captive coke. This we have thought out earlier. That's why we have set up this Dolvi Coke Project Limited. We have got environmental clearance to set up a 3 million ton coke oven plant, taking into account the shortfall at Vijayanagar and the shortfall at Dolvi. Plus, if at all we take up the next expansion from 5 million ton to 10 million ton, including that. Now 1.5 million ton is the actual shortage. That is why we would like to take up 1.5 million ton coke project. Out of that, Dolvi Coke will incur whatever expenditure that is required to be spent to set up this 1.5 million. Whereas to handle this coke to the feeding systems into JSW Dolvi, and also to send this surplus coke to Vijayanagar to create infrastructure for that, we need to spend 500 crores. So that is the project which is included as a part of this. These are the three major projects in addition to BF, which is coming up for relining at Salem. That we are taking a 30-day shutdown, which is factored in our guidance for this year. That also we have provided. So whatever projects I have talked about is very essential, where the payback period is less than 18 months time. The guidance for FY17 is concerned, we are giving a guidance of 25% growth. We have achieved, as I mentioned to you, 12.56 million ton last year. So this year, 15.75 million ton will be the crude steel. Similarly, sales side from 12.13 million ton, we are keeping a target of 15 million ton of sales, which is a 24% growth in volume terms. The domestic sales last year, overall, we have achieved 21% growth. We have sold 10.75 million ton in the domestic market, as against 8.9 million ton in the previous year. So when India grew by 4.5% or 5.5%, JSW Steel could achieve this growth of 21% in the domestic sales. Export sales fell from 26% to 12%, 3.2 million ton to 1.5 million ton. So that is the kind of switch which we could do and capture our domestic market. Our market share went up from 11.5% to 13% in FY16. If you look at FY17 guidance, again we wanted to sell more quantities in the domestic market. Jayant, during Q&A session, he will be able to elaborate what are the sales strategies we have to sell these incremental quantities, considering moderating imports, very challenging external environment, and also domestic competition. Taking this into account, we have put a strategy to sell the incremental quantities here. So with that, I think we are open for Q&A. Thank you. Yes.
Second question. One, this guidance of what sort of decline in imports and what sort of value consumption? What is the number for effect?
So we are expecting, last year the imports was about 12.6 million odd tons. So we are expecting that it will come down by at least half. So we're expecting imports in the imported 12.5 to maybe 6 point something, 6 odd million tons. The growth which we are expecting this year is 6%. WSA has given a growth for India at 5.4%. We are estimating it could be 6% on the back of public spending going up, FDIs coming in, hopefully a good monsoon coming up. So let's say about 5 million odd tons could come from growth. 6 million can come from import replacement. So the total window of opportunity is 11 million tons. Then you asked about exports.
The share of exports in the podium.
Yeah. So in terms of percentage, I think it will be just about 11% or so in our FY17 plan. So we are not increasing exports we're not planning exports in a very big way, given the current headwinds in the global markets. So we would watch the market and see if there's an opportunity, and we can always take a call. But we have planned for about 11%.
Yeah, just one request to all the participants. For the benefit of the audience who's listening to the webcast, would request everyone to speak into the mics, please, because we can hear each other very comfortably in the room, but for people in the webcast, there's an audio problem. So just request to even people on the podium to please request in the mic. Thank you.
Is it more proportionate to at least this is more of the developed subsidiary in which you have 40% stake? 1,000 crores is your proportionate, capex for this the entire project. And who is the balance shareholders who owns this?
No, the project cost for 1.5 million ton, other than infrastructure, feeding system, and for sending out the coke, that is included as a part of JSW Steel. So in this 7,000 crores guidance which I have given, 4,000 crores for this extra additional, that includes 500 crores of JSW Steel portion. Other than that, 2,000 crores will be incurred by Dolvi Coke to set up a 1.5 million ton plant. The structure of shareholding is that 40% is held by JSW Steel, balance 2 held by 2 private equity companies. One is the Access Capital, second is Standard Chartered. They are the 2 balance they are holding, almost equal. It is 100 crore equity and 700 crore quasi equity, so total 800. So balance is 1200 crore is the debt.
Clarification on this FDT. In this quarter, have we made this reversal or not? Because I hear in the notes that you mentioned the state government has gone to the Supreme Court and all. So how we have treated in accounts that FDT on iron ore?
Regarding FDT, so government has stopped as per direction of the court levying the FDT now. But at the same time, whatever we have to get refund, for the refund they have gone to the Supreme Court. And Supreme Court has fixed the date for the July. So, I think that is...
My question is basically how we have treated in this quarter in accounts.
Yes. The 23rd January onwards, the FDT rate has been increased from 8% to 12% because that was one of the contentions which has been debated in the High Court of Karnataka. The judgment is anything above 8% is not legal. So what the government has done is, and that is one. Number 2 is this FDT can be levied only on the companies which are controlled by the state government of Karnataka. So with that, MML can levy the FDT, number 1. Number 2, if at all they can levy only up to 8%. This is the judgment. That means NMDC you can't collect FDT. Private mining companies you cannot collect FDT. Based on this judgment, the state government of Karnataka went for an appeal. And the Karnataka government has also been asked to refund within 90 days, starting from 3rd of December. The response by Karnataka government is that from 23rd January onwards, they have increased the FDT by issuing a notification in a legal manner after getting all the clearances, 8 to 12%. That means whatever we are buying from MML in the e-auction, the duty FDT to be paid increased to 12%. So that has been debited to P&L account in this quarter. Whereas at the same time, Supreme Court has directed not to levy the FDT going forward. So they stopped levying FDT starting from February. So up to January, whatever FDT we have paid is debited. February onwards, it is not being collected other than MML, so that is not debited. Then earlier FDT paid, which we mentioned close to around 800-900 crores P&L impact and 1500 crores cash flow impact, that we have not touched because they have gone for a appeal, and the Supreme Court has given a stay until next hearing that they need not refund. So based on that, we have not reversed, we have not reversed in the P&L account.
Okay, thank you.
So my question is on the expansion that we're doing. SAIL is increasing capacity by around 7 million, and Tata Steel is also adding 3 million. So in terms of product mix, how are we placed as compared to the competition?
So in our business plan, if you see we are going in for approximately 2.9 million tons of increase in sales. So this 2.9 million ton consists of broadly about 1 million ton plus of hot rolled, primarily coming out of Dolvi after the blast furnace coming back, and about 1 million ton plus of rebars, combination of Dolvi and Vijayanagar, and balance between cold rolled and other products. So this is the composition. Now, with respect to competition, Tata Steel is coming up in hot roll space in Kalinganagar. In addition to that, the capability of SR and Bhushan exists to have an incremental production if there is a market available. So given the background which we have, what we have done is we have targeted that we will focus on the hot rolled strategy as a part of our MOU strategy. So we are taking about roughly 75 to 80% of our sales under MOUs. So we have our performance under MOUs have been more than 100% every year. So this year also we are earmarking about 75 to 80% of our sales through MOUs. The balance will be through the import replacement route, which again, if you look at Chennai and Bombay, were badly impacted by the imports, which would provide that space to do that. As far as rebars is concerned, rebars, Dolvi is the only bar mill in the primary sector in Western India. So we expect that there would be an opportunity for us to replace secondary sector in terms of quality as well. Cold rolled, we are looking at opportunities in the automotive where we have approvals already in process, which would fructify. So we have cold rolled through the automotive route, some through the import replacement route, and the MOU route. So this is the way we have structured our incremental sales this year vis-a-vis last year.
So how long are these MOUs? Meaning, how does the pricing work? Is it fixed for a period of time, or it only the quantity is fixed? And
so what happens typically? Am I audible?
Hello. Yeah. So typically, what happens in our MOUs is we have a quantity contract, which is laid down with respect to certain parameters of turnover discount and certain other relationship incentives, which is built in as a part of the MOU. So if you achieve that, then this is what you get. So that's built in as a part of the MOU. And we have been having this since many years. It's not something new in terms of an initiative. But what we are trying to do is we are trying to add more new customers, and we are increasing our volume with existing customers as well.
So last question, we have been reading in some of the industry reports that the pricing differential in rebar between primary and secondary produces as large as 5,000 rupees. Is it true, and how long can it last?
Yeah, so what has happened is the secondary, I think, market went up, substantially in between, and then again corrected thereafter. So the primary has gone up in line with the secondary, but did not correct as much thereafter. So the gap has increased. Now, whether it is 3,000 or 5,000, it will depend on market to market, I suppose. But what we believe is a sustainable gap, I think would be reached as you reach the monsoon season. So there would be some corrections which will happen probably in the primary sectors as well. So you will see the gap coming down. We believe about 2,000, in that range, 2,000, 2,500, depending on the brand, between primary and secondary can sustain.
Yeah. Yes, a couple of questions, mainly on the iron ore. So this category C iron ore auction, I think the 11 mines have been shortlisted and the date is June. So one is the stamp duty confusion resolved and the auctions would happen in June? And my second question is the Karnataka iron ore production run rate. I was reading few reports where next year production is expected around 29 million ton. So we are already hitting a ceiling of 30 million in Karnataka. So what are the steps taken by industry to take that ceiling up already? Because now the category C would also be auctioned. So, and there is a surplus iron ore all over. So can that ceiling be lifted and what are the steps taken for that?
Regarding C category mines, Government of Karnataka has given commitment to Supreme Court that they are going to conduct the auctions in the month of July. And for the stamp duty finalization is the pending, and in next cabinet it is going to be on 23rd. Hopefully it will get resolved in that. Already draft they have prepared. And once this 23rd they pass the order, then they will communicate to the industries, those who are going to participate in the auction. And actually today the date is 22nd of the July to announce the final bidders for that. And hopefully this will happen on that. Regarding quantity of the 30 million, last year it was 24 million production, and this year is hopefully it will be 29 to 30 million. And we are very much hopeful to get around 20 million out of that.
No, so my question was, can this, because the ceiling is 30, so what happens in FY18? Can that ceiling, because you have to start working now to increase that ceiling for higher iron production?
On ceiling also there was affidavit from the Government of Karnataka. The ceiling has to be increased to 40 and 50 million. That it depends actually when court opens, how the court will decide on that. But hopefully the 30 million ceiling can be go to 40 million on phase manner once they improve the infrastructure in the Karnataka. Some conditions they are going to impose on that.
And my last question is on the overseas EBITDA and cash loss run rate. I think US plate mill again reported $10 million EBITDA loss. So what should we model it for FY17, or what's your outlook for FY17 for US plate and pipe mill and also the Chile iron ore operations and coking coal operations? What can be the EBITDA and the cash loss run rate?
As far as Chile and the US coal is concerned, I think we are not seeing any restarting in the near future. So FY17, the expenditure which is at the current levels, it will continue to be there. As regards to plate and pipe mill, it may not be negative EBITDA. At least it will be break even at the EBITDA level. That is what we are seeing for FY17. That is how we have factored our business plan.
Yeah, thanks a lot.
Sir, on pricing, as of today, how much would prices be up compared to where the blended realizations were for 4Q?
As of today?
As of today for the company, I mean 2, 3, 4, 5, how should we look at it?
So between January, let's say it bottomed out in December and Jan. So between February and March, our prices went up by ballpark 15%. After that, the prices have gone up in April and May, maybe by another 10%. The transmission, as Mr. Rao was explaining in the last quarter, was 2% in the market, primarily because of the volume mix, contracts, the prices having gone up only in the month of February and March gradually, etc. So the major part of the transmission will happen in the quarter April-June.
Broadly, around 4,000 rupees, can we expect NSRs to be higher in the June quarter versus the March quarter? 20% of 29,000, roughly 4,800, that's what it works out to.
No, here the way I think one need to look at, again, we have a mix of products. For instance, long products, whatever percentages Jayant has given may not be true. Right? Price goes on changing every day, and the secondary steel players constitute a significant portion. Then as regards to blended realization, still 1.5 months is left. What will happen next 1.5 months is anybody's guess. So we don't want to guide what would be the blended realization increase. What we can say right now is 15% increase point to point was there in the last quarter, got reflected 2%. There is further increase in April, which is 10%. So total together is 25. This 25 is not across all the products. Long products you have to exclude. Wherever quarterly is there, you have to exclude. Wherever exports are there, you have to exclude. If you exclude these three products, balanced products, this will happen. So this will get reflected, assuming that this will continue. This trend will continue for the next 1.5 months.
And most of this should flow through to the EBITDA line.
Yes.
Okay. So second question is regarding the exploratory bid for those UK assets. Can you give us some more color on the thought process behind it? Because the bids will get open now in June, and I guess the process would get completed by July. So where does JSW stand in terms of their entire process?
So today, every time we have been clarifying, as and when any acquisition is there, JSW Steel name get attached to that. Whereas for the last 15 years, we have been explaining to all of you what is our strategy. Our strategy is focus in India as far as the basic steel making, and then look at forward and backward integration if opportunities are there anywhere overseas. That is how we have done. At some of the acquisitions we have made overseas, we must have lost money in that strategy, but it is strategic in nature as far as we are concerned. Similarly, this particular asset we are looking, it is exploratory, that is what we said. We wanted to stick to our strategy, what we have been explaining to you. So in that direction only we will do, if at all we do anything in this. So it is as on date, it is completely exploratory.
So my third question is on the guidance. There is a capex guidance which gives a breakup in terms of equity and debt. So should we assume net debt to increase in FY17 by that amount? Or, I mean, because given where the prices are and profitability is, logically it would have meant net debt would have fallen substantially in FY17.
As far as overall debt is concerned, it will not go up beyond what is there as on 31st March 2016. Taking into account the capital expenditure program of 4,200 crores, which will incur in this year. And also we are factoring a significant reduction in the acceptances. So working capital will put more money in this year. Only one point we would like to clarify is that Ind AS. Ind AS is effective from 1st of April 2016. When we announce our results for the quarter one, we will give you more color as far as the impact on JSW Steel is concerned. But even 31st March 2016 numbers, even including all the quarters, will get reinstated as per Ind AS. So the impact of Ind AS you have to take into account at the time when we see the total debt. Because as you know, there are 4 items which will impact as far as the Ind AS is concerned, even though there are several items. These 4 items which are major. One is embedded lease. Any take or pay obligations, any company enters into that, automatically the debt and EBITDA will come into the company. So the company has long-term contracts either for port or for DRI buying. There are certain contracts, so therefore it will have an impact of this. Similarly, the preference share, we have been treating it so far as equity, it will become debt, and the dividend payable on the preference share will become an expense, as interest expense. So that is the second change. The third change is prior to effectiveness of Ind AS, if any acquisitions or mergers that are done, if they are done at the fair values, at the time as per Indian accounting standard, you need not provide deferred tax liability. Whereas once you migrate to this, those differences are not permanent in nature, so therefore you have to provide deferred tax liability. So there will be an impact. The last item which will have an impact definitely is financial instruments. Any investments that have been made in a listed securities like JSW Energy or any other company, it has to be done at fair value. So therefore my request is keep it in mind these impacts which can come in due to which my debt can go up. Other than that, we are not envisaging any increase in debt. If at all, there will be downward.
Sir, acceptances would remain separate out of debt under the Indian accounting standards, or will they get clubbed under debt?
No, it will not get added.
It won't get added.
No.
And right now, so how much would be the capital advances be?
Capital acceptances is $447 million US.
$447 million.
Yes.
Thank you, sir.
On acquisitions, two things. One is, what is the
internal benchmark we have in terms of payback period? That's first. And second is, what is, if at all we do acquisitions, what is the amount we have an upper cap in mind for acquisitions?
No, as far as the payback period is concerned, considering the rationalizing the capex, we have taken, as I mentioned in my opening remark, if the payback period is more than 18 months, we are not investing. So that is as regards to all the capital projects which we talked about. This other than essential infrastructure, statutory, environment and maintenance capex that we need to incur. Similarly, mining assets we have provided close to 400 crores into this. Whenever any iron ore acquisition that will happen in India, we have provided for that, including the development, including Moitra coal mine. Any new acquisitions, it should be above our WACC, weighted average cost of capital. So weighted average cost of capital, we are looking at around 14%, 14-15%, that is the range. So based on that, we will take the call.
The total amount, is there any amount that we would specify that we would not exceed or that is fluid?
No, as regards to overall financial ratios we have been guiding, which we said 3.75 debt to EBITDA, 1.75 debt to net worth. This is what we have been guiding. Excepting last year where there was an aberration due to which the ratios went haywire. Our desire is that to maintain those ratios, to bring it down to those levels. So we will work very hard towards that. So we don't want to exceed whatever ratios we have seen. So we will keep ratios under control and we are very cautious about it.
Thank you very much.
Hi, can I ask a question about the cost per ton? I think in Q3 you mentioned there was a 1,100 rupee drag on EBITDA per ton due to the shutdowns. What's the equivalent figure for Q4, given that you only started the facilities in February and March? How much was the EBITDA per ton depressed by? I think it was 1,176 in Q3.
Yeah, last time I mentioned the total 3,400 crores, 3,400 rupees per ton was the EBITDA in the Q3. If I don't take into account the shutdown expenditure plus the inventory losses, this will be 4,600 rupees. Now our EBITDA is 5,400 rupees in the last quarter. So shutdown expenditure for 1.5 months continued even in the last quarter, last quarter, but there is no inventory loss. Inventory loss is little positive, in fact, in my view, last quarter. So therefore, they are not there in the last quarter, more or less.
So negligible?
Yes.
Okay. My second question, please, on the dividend. It went down from 11 to 7.5 rupees per share, given a relatively bullish outlook on demand and investing in some new projects. Just interested in the thinking behind that.
The dividend 11 to 7.5, given the bullish outlook, and what are the projects we're investing in by board?
So here, the way we looked at is because of the impairments, the company had a net loss of over 700 crores on a consolidated basis. As a company's policy, we have been maintaining that we will declare a dividend of 20% on the consolidated net profit. That is a policy which we have been following. Whereas in this year, even though we have deviated from that policy, our board has taken a call that considering the FY17, where we are expected to do well relative to FY16, so we should give the dividend maybe at a lower level, even considering the capex program of the company. So we should be able to do that. The way we have guided that there will be a 25% growth in volume of production and 24% in volume of sales, and then there will be a better margins in FY17. Taking that into account, after incurring this capex, I don't think there will be a problem in this.
Thank you.
Sir, just a couple of clarifications. With regards to category C mines, the bidding that will happen, is that excluded from the 30 million ton limit which is there, or it does get included in that?
As in today, it is within the 30 million, But as the proposal has gone to Supreme Court from the government of Karnataka, they want it has to be over and above 30 million.
Okay. And sir, what is the time frame that will be involved in terms of commissioning of those mines?
Say suppose if they give the finalize the vendor bidder in July, then it will give 18 months time. So some of the mines will come within 6 months. Some of the mines may take 1 year, 1.5 years.
And we won't require any further investments as far as commissioning, apart from the development work that we'll need to do.
It's only for development and some small R&R work.
Okay. Secondly, can you share the numbers for Amba River Coke and Salav unit and the EBITDA numbers for this quarter?
Amba River EBITDA for this quarter is 166.73 crores. Because the coke which is produced, everything has been sold. That's why there is an EBITDA in this quarter. Earlier quarters were not there. Salav, there is a negative EBITDA of 9 crores because there were old stocks, highly expensive inventory which they have used it in this quarter. That's why the losses were 9. Anything else you wanted?
No. So last question, the percentages price increase that you mentioned with regards to 15% and the 10%, the base is January prices, right? January low prices. Yes. Thanks a lot, sir.
January prices fell. In fact, January prices fell relative to December.
Hi, sir. Just a couple of questions on the Ind AS again. How about the debtor securitization? Is that a concern that will also be added back to debt?
I think we can give more information about Ind AS because there are a lot of items, so which will not be able to cover all those items. But major items I have said, these 4 items are major which will have an impact.
So just the last one, acceptances, you said it's not going to be added.
Yes. It's not included in the debt I'm saying.
Okay. And sir, the revenue acceptances for this quarter in March?
Revenue?
Acceptances, you mentioned capital was 447.
Yes. 1233 million revenue.
Okay. Thank you, sir.
So, if you can just throw some light in terms of what fall was there in iron ore and coal separately.
No, because there are so many locations, it is not possible to identify what is iron ore cost and what is coal cost. One thing which we can tell you is iron ore prices in the last quarter relative to the Q3 went up. Prices were higher, which I told you already 150 rupees increase, which has been made by NMDC. The NMDC increased, all the mining companies increased the prices, particularly in Karnataka. As far as coal is concerned, last quarter we guided that $5 per ton will be lower. In fact, it is a little higher than $5. Coal prices were lower in the Q4 relative to Q3. That is why the increase in iron ore prices were more than offset by way of a saving in the coal. So you find a lower cost of production in the raw material side sequentially.
And sir, this cost base is right now maintained on both coal and iron ore. So we have kind of now at the same level.
As far as costs are concerned, in the case of iron ore, there could be some upward movement, particularly in Karnataka. Because the NMDC out of 24 million ton, they produced last year 12 million ton. 50% is by NMDC. Similarly, in this year, when we are saying 29-30 million ton can come in, NMDC remain at 12 million ton. So there is a significant portion. If you see the trend, what NMDC has done in the last 2 months, when they increased the prices in Chhattisgarh, they increased more than that in Karnataka. One. Number two, when they reduced the prices in Chhattisgarh, they didn't reduce in Karnataka. So because of that, we are factoring in this year, iron ore prices in Karnataka could be higher than what it was in the last year.
Okay, and sir, just last one on iron ore, what would be the mix of sourcing from various geographies?
So that will again depend from plant to plant. So Vijayanagar, I think Dr. Naval has explained, our requirement is about 22 odd million. We expect 20 million to come from Karnataka. We are expecting maybe some additional possibilities in Karnataka as well. If not, we would source that item from outside, either from Orissa or from alternate locations. As far as Dolvi and Salem are concerned, we have an option between various sources, import and Orissa being the major ones. So these would be the broad sourcing strategies.
Sure, sir. Thanks and best of luck.
Hi, sir. Sir, on import parity basis, how do you see the domestic pricing right now?
So the imported prices, or rather the international prices, have, as we were discussing, it moved to $470 on a spot level from $270, and is now somewhere in the $370s as we speak, FOB China. It has not gone down to that extent in the rest of the world. I think Europe and US still remain quite elevated in terms of prices. So internationally, the numbers have been a little volatile. Coming into India, I think we would say broadly that steel cannot right now come in below $445. So your benchmark number in domestic sustenance is about that level.
Sir, I was just trying to get an answer from the earlier question. So what's the incremental scope of increasing prices in a scenario if MIP is reinstated? And secondly, what is it that we are hearing, say post 8th August, once MIP is taken off? What is the comfort that we have that domestic steel prices will remain this strong?
See, price again is a corollary of supply and demand. So why we do not want to comment exactly on the price line going forward is because it is very difficult to comment on that, given the fact that supply dynamics may change. So today, if you see China, why has the prices dropped so much? It's primarily because the production went up. You have the numbers yourself. So 2.31 million tons in April, prior to that 70 million ton in March. And as we speak, their domestic consumptions have fallen, so the only way out for them is export. So therefore, the risk in the international market, given the Chinese volatility, is certainly there. It will exist. Now, if you come to India, now we have some kind of a barrier today with respect to the minimum import price. We also have the safeguard, although they will not apply concurrently, but we have a safeguard applicable for 3 years. We have filed for anti-dumping duties on hot rolled, cold rolled, and some other products are in the process. Initiation has already happened for 2 of them, hot rolled and cold rolled. So we expect some long-term measures in terms of anti-dumping to fall in place for specific countries with respect to these products at least on a provisional basis soon. So we do hope that we will not be exposed to the vagaries of the Chinese volatility the way we were exposed to last year. So therefore the sustainability may be more, but having said that, we also keep in mind that the domestic supply would go up. We are ballpark estimating that about 7 to 8 million tons in terms of supply could come in the domestic market on the flat side, which would be offset by a drop in import and the growth in the demand. So as long as the imports are contained, I think the supply-demand balance can be maintained. But we'll have to see how it goes as we go forward.
Right. Sir, you said 3 years of safeguard. Is it only for HRC or are there any
Safeguard as of now is for hot roll, yes.
So do we expect the government to act swiftly? So it can be a scenario wherein Chinese steel prices go down, and it can create a scenario wherein we might have to reduce prices. So do we fear any such scenarios?
Yeah, so anti-dumping, as I said, already initiation has happened for 2 products. Hot rolled is 6 million tons out of your total 12 million ton of import. So that's a major chunk initiated. Cold rolled, again, import is also the second largest item. So these 2 initiations have already happened. We expect some results on the provisional side maybe soon. But if imports were to open up, then yes, there could be some risk in terms of price adjustments.
Thank you. Second question is on the cost saving sides. Incrementally, what are the levers that we have? So one could be basically the steel making mix can change given we have new capacities in place. If you could provide some more color on steel making mix and other avenues that we have.
No, I think location by location we have strategies what is required to be done in order to save more costs. So if I look at Vijayanagar, we have recommissioned our blast furnace. Therefore, there is a huge amount of savings which we can get through fuel efficiency. Because blast furnace earlier and now, if you compare, it is a bigger furnace. It uses lesser fuel. That is one big advantage. The second one is relating to logistics. We have done a lot of changes in the logistics management. So there we are expecting savings to come in. If I see the Dolvi, as I was explaining earlier, now blast furnace has been commissioned. Earlier the proportion of DRI and hot metal used to be 55% hot metal, balance used to be DRI. Now we expect this year it will be 65% plus. You are aware that hot metal cost is lower than DRI. That will give the benefit substantially here. That is the second. Then if I look at as far as the Salem is concerned, there also we have taken several other measures, like there is product mix side, the annealing furnace which we are setting up, and there is waste heat recovery boiler which we are setting up to capture the gas. So these measures should give us cost reduction overall, in addition to prices side, market what it gives relative to last year. That also we expect something we should be able to get. Plus iron ore side, again hedging as a tool for the futures. We are also looking at that very carefully to get some benefit out of that, because futures are trading at much discount to the spot.
Sir, would you like to put a number to all the measures that you cited?
That is anybody's guess, but only we are saying we are making every effort to see that costs are reduced.
Sir, last question on covenants. How is it that we are negotiating with the banks on this? Is it something which will remain the same, or it will change incrementally?
No, covenants we have got all the clearances excepting only one very minor exposure. We are very sure that we'll be able to get it before the testing is to be done. So covenants more or less we have got all the clearances. The way we have got the clearance from all the lenders is that either March exempted, that means we need not test. If it is tested, it is 6.75 debt to EBITDA. Debt to net worth is 2.5 times. So these are the for 31st March 2016. So some lenders have given exemption that we need not test it, whoever have given with these conditions. If I look at 2017, the 6.75 we have to bring it down to 5. As far as debt to net worth is concerned, this 2.5 will continue for March 17. If you go to March 18 and thereafter, the debt to EBITDA we have to bring it down to 4, and the debt to net worth to 2. So these are the covenants. We have got the clearances, so we have no issues on that.
Thank you so much.
Sir,
Yeah. No, negative net working capital, I think the way you have to look at is the payments due within 1 year, term loans, if you take it out. Similarly, the capital related creditors and also the acceptances. If you take these items and then look at the pure trade related liabilities, trade related assets, then our current ratio is very close to 0.9. So from that point of view, I don't think nothing to be concerned about it. So as far as capital advances are concerned, that is the ongoing basis, that is the outstanding liabilities which we are continuing. So there is sustainable those issues.
I have a few questions from participants on the webcast. Any plans of buying iron ore resource company in Karnataka or Odisha rather than buying new mines via auction, which takes time to ramp up? And if yes, have you shortlisted anyone?
No, today buying of any iron ore mine under new MMDR bill is not possible unless it is captive. Any merchant mine is not possible. So therefore, there are very few opportunities where acquisition is workable as regards to iron ore mines. So therefore, the only way of acquiring iron ore mines in India, mostly through auction. So we don't restrict only to Karnataka. We will go even beyond Karnataka, either Orissa or Chhattisgarh or wherever it is.
Another question is, given that the company has a target debt to EBITDA of below 3.75 times, does it mean that any acquisition will likely be equity driven?
So I think we have to do at the relevant time and structuring that. It is 3.75 when I said suddenly when acquisition happens, it may go temporarily, and after that it will come down to these levels. That is the desired levels which we would like to maintain.
And what is your receivable dues of more than 90 days from contracted sales?
I don't have the number right now, but we can give it to you. You can share it with them.
Sir, just a couple of questions. One is regarding the guidance for volume. You said 15 million tons. What is the likely split between flats and longs?
Flexibility we should have. No, earlier we used to give the breakup, but now why we don't want to give the separately? For instance, we have the flexibility of producing either long or flat at Vijayanagar. So therefore we wanted to have that flexibility. So 15 million is more relevant, but only one information I can share. Out of 18 million ton total installed capacity, we have today more than 5 million ton of long. So we can produce that long. So that flexibility we have today.
So second question is, what are the debt repayment obligations for FY17 and FY18, and what is the average cost of debt?
Average cost of?
Debt.
The repayments in FY17 is 4,300 crores. So it is in a similar range. If I look at FY, I don't remember FY18 number, but it is in the similar range. Then the next question, weighted cost.
Yeah, weighted average cost of debt.
Weighted?
Average cost of debt.
Weighted average cost of debt as on 31st March 2016 is 7.16%, which is 16 basis points lower than 31st March 15.
Okay, sir. And what is the tax rate guidance for next year?
Guidance will be the same. I don't think there is any reduction as far as the overall cost is, overall tax provision is concerned to P&L. It will be at a level of 30% plus.
Yes, sir. Thank you, sir, and all the best.
Hey, sir, here. I have one question. At the time of announcing the MIP, the government had said that they will monitor the steel prices very closely. Now, obviously, the MIP will come for the renewal in the August. You think that the steel industry will be able to justify this 25% price increase, which has happened in 2-3 months, and how the government will take it? Like, because there is a buyer sector also, and they also have their voice in front of the government.
So that is what Jain, I think, has clarified. If you look at USA, there is $670 is the prices at which it is sold. And Europe, there is a $500 it is getting sold, but no user is complaining.
Okay.
Whereas in China, because they are dumping in their own country, it has come down, they want to dump into India. In the price increases in India, you have to look at from the international global point of view. Globally, we have given the data. From $270, it moved up to $470, which is 78 or 80%. India, we are saying we have increased by 25%. So there is still a huge amount of gap between what happened in the domestic market and what happened internationally. So if you look at international prices versus domestic steel prices, I don't link it to MIP, because of MIP prices have gone up. International prices have gone up, domestic prices have gone up. But only benefit of MIP is imports are moderating, which we have seen in the month of April, even though it is not to the extent which we all desire. 6 lakh tons per month, which used to be 1 million tons. So that is only positive we are seeing, not from the pricing point of view. If international prices have not gone up to this extent, domestic prices also might not have gone up to this extent.
Okay, thank you.
I have one more question from the webcast. Given that your offshore bonds are trading below par, would you be considering buying back some of those?
Yeah, we always look at that option, but only it requires some regulatory approvals. So if they are in place, we will always look at buying. It is not a problem at all.
Just one question. The payables related to the current expansion which has got completed, is that included in the capex guidance for next year in terms of cash flows?
No, this is the total cash outflow. So our assumption is the outstanding capex acceptances and also capex creditors. Because there is again 7,000 crores of capex, they will be maintained at that level. So therefore, overall cash outflow will be 4,200 crores.
Okay, and just last question is on the other operating income, that seems to have gone up quite sharply sequentially from almost 62 crores to 183 crores.
Yes.
I understand the volumes have gone up, but is there any other reason for that?
Yes. So here volumes have gone up because of that VAT benefit has come, that is one. Number two is in the state of Karnataka, incremental production which we are doing, there is also a VAT benefit. So that VAT benefit also has been taken here for the entire year. That is also there in this.
What do you mean by incremental production? That's the
So
from
we
the
have
new
got
capacity?
we have got the incentive like in Maharashtra, even in Karnataka, when we went for expansion from 10 to 16. So that benefit is available on the incremental production. So that benefit has been taken into account.
Thank you.
So just a follow-up question. Without getting into the specifics of the new accounting policy, broadly, if you were to restate your current debt, as per the new accounting policy, how much would that net debt number be?
See, we have to work out the correct numbers because there is a lot of issues involved in that. So there will be an increase definitely in the overall debt. How much it would be, I will be able to share with you when we come in July, when we meet in July. Yes. Total amount which we have taken is 112 crores. 12 crores. 112 starting from October 2014 up to March 2016. This is the amount involved. So the way they have given is that this benefit, any CST which we pay in excess of 300 crores over a year, anything above I will pay, I will get that amount back. So therefore in the next year also, that is in the current year, FY17, up to 300 crores I will not get any benefit. Anything I sell giving a revenue of more than 300 crores, I will get the refund. It could come, yes.
The debt figure that need to be considered over there, will that be as per the existing accounting or the revised?
Revised.
Yeah, one question. What's the current portion of long-term borrowing which is reported in other current liabilities?
As I mentioned to you, 4,300 crore is what is due for the next 12 months.
So that is reported in that other current liability.
Right.
Okay, thank you.
Last question. So MIP has been very broad and it's applicable on a lot of product categories. But anti-dumping duty will be like one or two categories here and there. Will it be same effective, against imports as MIP has been to some extent?
Yeah, so MIP, you're right. MIP is far more broad-based than what anti-dumping. And anti-dumping is again country-specific, vis-a-vis, let's say MIP or safeguard. So it will be our effort to see that MIP is extended, but that's something which is difficult to forecast as of now. But I think the government is aware that today the structural overcapacity which exists in China and Japan and Korea being again exporting nations, so they would try to keep in mind the kind of problems which are happening in the steel industry world over, what's happened in the UK as well. And the domestic industry current situation in terms of the debt, in terms of the profitability, I think they would keep those things in mind before they change, any of their MIP lines which they have taken, the harmonic lines.
In continuation with MIP, does it face any major challenge under WTO? Because we have been hearing a lot about, other countries objecting under it.
It is as per the foreign trade policy. So it is, like US also has done certain steps which may be probably not exactly as per the WTO per se. But in India, what we have done is as per the foreign trade policy.
No, after 2009, under Uruguay round, where they said trade remedial actions can be taken, somebody analyzed from 2009 to 2014 all the remedial actions which have been taken across the world. 28% of those actions are MIP or similar in the world. It's not that India alone has taken this step. So there could be arguments that it is not WTO compliant, but we are sure it is WTO compliant. We will be able to defend.
Sir, regarding this Dolby expansion also is VAT exemption available in the expanded capacity? The VAT refund what we claim in the Dolby unit?
Yes, but it is not on the similar lines. There is a slight change here. That is on gross VAT basis, it is a net VAT basis. Whatever we have got for the expansion.
So the VAT paid in Maharashtra sales is refunded as of now, so that continues.
That's what I explained. Existing up to 3 million ton, it is on gross VAT. That means if we are paying 5% VAT on the finished goods sold in the Karnataka, entire 5% is refunded. Whereas in the new policy, which has come in now for expansion, it is a net. That means if I pay 5%, any inputs which I buy, VAT is paid. Net of that amount only will be refunded. So amount is lower in the expansion per ton of steel sold within Maharashtra.
And what in Karnataka from 10 to 16 million going up, any number, any tax paid number above 300 crores get refunded?
Correct.
Thank you.
CST. This is not VAT.
Yes, CST.
VAT, there is another clause in the same exemption. If it is VAT in excess of 200 crores paid in a year, we will get in the form of a loan payable after 14 years. Each installment after 14 years. That is for VAT within Karnataka.
Thanks a lot.
Anything else? Thank you very much.
Thank you very much. You're all requested to join us for high tea in the cafeteria. Thank you.
Amount you should count. As good as same benefit.